The announcement by President Donald Trump to impose an additional 10% tariff on Canadian imports marks a significant and seemingly capricious escalation of the ongoing trade dispute between the two historically close allies. What distinguishes this tariff hike from previous trade actions is its stated primary rationale: a punitive response to an anti-tariff advertisement aired in the U.S. by the provincial government of Ontario. This development transforms a traditional economic conflict into one defined by political and personal grievances, with tangible negative consequences for businesses and consumers in both nations. Reasons and analysis of the escalation. The immediate trigger for the 10% tariff was an Ontario-sponsored advertisement that quoted former Republican President Ronald Reagan criticizing the negative impact of high tariffs. President Trump reacted strongly on social media, labeling the ad a fraudulent advertisement and a hostile act that misrepresented Reagan's views. He further claimed the ad was intended to influence the U.S. Supreme Court, which is scheduled to hear arguments on the legality of his broad tariff authority. This response highlights a governing style where trade policy is intertwined with personal offense and political maneuvering. The underlying reasons for the trade tension, however, are far more complex and predate this incident. They include broader tariff strategy. The current administration views tariffs as a crucial tool to rebalance trade deficits, protect domestic industries, and secure the southern U.S. border by linking trade to issues like illegal immigration and fentanyl trafficking. Existing tariffs. Canada was already subject to a 35% tariff on many non-USMCA compliant goods and up to 50% on sectors like steel and aluminum. The new 10% is in addition to these existing duties, signaling a heightened willingness to use economic leverage. Trade negotiations breakdown. The advertising dispute caused President Trump to terminate all ongoing trade negotiations with Canada, removing the primary diplomatic channel for resolving existing sectoral tariffs. Consequences for North America. The economic fallout of this tariff escalation is significant for both sides, given the deep integration of the North American economy, where over 3/4 of Canadian exports head to the U.S. Consequences for Canada. Reduced competitiveness and GDP slowdown. Canadian exports will become more expensive and less competitive in the U.S. market, which will likely lead to lower export volumes. Economists predict this move, combined with earlier tariffs, could substantially slow Canadian GDP growth. Sectoral strain. Industries already battered by existing high tariffs, such as automobiles, steel, aluminum, and lumber, will face intensified pressure. This will lead to reduced firm profitability, job losses, and a decline in private investment. Currency impact. The Canadian dollar, loonie, is likely to weaken further against the US dollar, although a weaker currency can partially offset the tariff costs by making Canadian goods cheaper in US dollar terms. Consequences for the United States. Higher consumer costs. Tariffs are a tax paid by the importing country. U.S. manufacturers relying on Canadian inputs, e.g. steel, aluminum, energy, will face higher costs, which are typically passed on to American consumers as increased prices for finished goods like cars, appliances, and certain food products. Supply chain disruption. Companies with integrated cross-border supply chains will incur greater logistical complexity and financial costs, undermining North American competitiveness against global rivals. Inflationary pressure. The tariffs contribute to overall higher prices, adding to inflationary pressures in the U.S. economy. Prediction and solutions. The short-term prediction is continued friction. With the current trade talks terminated, the trade war is expected to intensify, driven by tit-for-tat retaliation. Canada may feel compelled to impose new or reinstate previous retaliatory tariffs on specific U.S. goods, perpetuating the cycle of economic harm. The long-term prediction hinges on political stability and legal challenges. If the U.S. Supreme Court were to rule against the president's use of certain emergency powers to impose sweeping tariffs, a large portion of the current levies could be quashed, leading to a de-escalation. Absent such a ruling, the USMCA review, scheduled for the coming years, becomes a high-stakes moment that could either stabilize or completely unravel North American trade relations. Potential solutions. De-escalation via diplomacy. The most immediate solution lies in Canada's recent pragmatic move to pause the Ontario anti-tariff ad campaign, This action removes the immediate political flashpoint and could open a pathway for the U.S. to resume trade talks, even if informally, allowing officials to negotiate sector-specific tariff reductions. Canadian economic diversification. Canadian Prime Minister Mark Carney has outlined a strategy to mitigate U.S. risk by doubling non-U.S. exports over the next decade. By deepening trade ties with new partners in Asia and Europe, Canada reduces its dependence on the U.S. market, currently over 75% of its exports, thereby reducing future U.S. leverage. Fiscal and monetary response. Canada's central bank and government may respond with interest rate cuts and targeted fiscal support for affected industries, respectively, to stabilize the domestic economy and aid struggling businesses. U.S. stakeholder pressure. American manufacturers, farmers, and retailers who rely on Canadian inputs and face rising costs are expected to increase political pressure on the White House to resolve the dispute, highlighting the domestic harm of the tariffs.